And hello, everybody. We find ourselves on a not rainy day today, which, given the last time we were on one of these ERMIC meetings, it was chucking it down. Nice to see you all again. And I understand that the way this morning has gone is that everybody might be feeling just a little bit scared by the future prospect of climate. I hear that it's been brought to front of mind very much, the kind of risks that we're facing. And the good news is, I want to tell you that we have tools and models that are going to help each of you as risk managers to do something about it. And it's our job today to walk you through some of those tools and models so that you can begin thinking about how you're going to get your arms around climate and the new reporting requirements. So before I get cracking with the panel, I did just want to share with you one slide which we've put together, because I'm sure you're well aware that 2 weeks ago, the UK government made some new TCFD reporting requirements for climate, which is going to be physical risk and transition risk, which you're all going to have to get to grips with. And so what I wanted to do was almost underpin today's presentation with that thought that over the next 1 to 2 years, you are going to need to begin doing some quantification of what that risk means for you and get your arms around those metrics and the way to do it. And this slide shows if you fall into one of the different industry categories, what you're going to have to be doing. And then it also shows the timescale over which you're going to have to be doing it. So this is there for you. If you'd like a copy of it, we can make it available afterwards. Just give us a shout. But I've spent a lot of time over the last couple of months working on how we practically are helping people get their arms around climate. And so whether that's getting it written into your annual report, whether it's laying out a roadmap for what you're going to do over the coming months, whether it's about updating your ERM, your risk management strategy, your risk register, to now have climate change featuring within it. Those are all things that I expect you're wanting to do, but you're not alone, and we can absolutely help with that. That's the role of Julia and organisations like ours. So, key message, don't be afraid, sit back and enjoy the next 45 minutes, which we're going to wow you out with some of the new modelling technology. So to do that, I am absolutely delighted to have an international cast for you today. We have 3 wonderful speakers lined up, and I'm going to give you their long introduction before each of them come on. But just to let you know, we've got Jordanka, who works for Swiss Re, who's very much in the thick of using these models for investment strategies. We've got Peter from AIR, who is been working in the climate arena for well over a decade and brings a wealth of knowledge about modelling and how we're adapting the models. And then we've got Catherine, who is very much hands-on, working for FM Global, dealing with flood and climate risk and how we can practically help with that every day. So we're going to kick off with Jordanka giving us the background to which models, which of the climate perils are going to become more important as we go forward. Jordanka works at Swiss Re in the cat perils and cyber team, and she's the interface with international stakeholders working on underwriting and also risk management. She's also working a lot with regulators and investors, so brings a very well-rounded view of this. Interestingly, Jordanka speaks Japanese, and so don't be surprised if she jumps into a spot of Japanese during the presentation, and she holds an economics degree from the University of Tokyo. Over to you, Jordanka. Thanks very much.
Good afternoon, everyone, and thank you, Beth, very much for this kind introduction. It is a pleasure to be part of the ERMIC conference, and in particular this panel discussion together with Peter and Catherine, and you, Beth, of course. So I'm going to talk about why climate change matters for a global reinsurer, and build a lot on what you've heard from a colleague of mine, Martin Bertok, this morning. A discussion about climate change. I'm trying to move to the next slide and the button is not, oh, here we are. Maybe, hopefully didn't click more. Yeah, I think we'll manage now going forward. Thanks a lot. So Any discussion about climate change usually starts when we talk about how the economic as well as insured losses from natural catastrophes are on the rise. You've seen that slide earlier this morning. While in the early 70s, the loss that was being borne by the insurance industry was at about 3.5 billion. The 10-year moving average today from the last century is bigger by a factor of approximately 20, above 60 billion. And often the questions that we get asked in the team I'm in or other colleagues is saying, can you now, okay, very interesting data, can you please tell us and attribute how much of that is being driven by climate change? How much is attributable to that? A very simple question, but not necessarily a simple answer. And Martin this morning alluded to that a little bit, because we have this very intricate interplay between all kinds of macro drivers that are causing the rise of these both economic and insured losses shown on that slide. Just try to move to the next one. When we talk about these macro trends, sticking a little bit to the climate change, which you've heard a lot about, I don't have to comment or give the stats about it. What matters about the climate change is that it's not always that immediately easy to say, are we talking the natural climate variability, which is part of a longer term trend, or are we really talking about the anthropogenic, the climate change that is caused by the humans? Ultimately, for a risk assessment, in the end, does not matter, because what matters is that we are capturing what we are observing today and what we expect to happen in the near term, for where the risk assessment applies, rather than we're looking at very long history averages, which might be sometimes misleading. But when we talk about these macro trends and growing losses, what basically until today has been the main driver is the economic development. Global GDP in the last half century, it has risen by a factor of 60. We have urban population in the same time span about 2.5 times more. A lot of these assets are accumulating and moving to exposed areas, and that's where we see a lot of those impacts and what manifests. Briefly, would like to mention the category in these macro trends that we call insurance penetration. This comes from insurance take-up rates. When we talk about corporates, that could be then the breadth of coverage, which perils are being covered, in what scope, what are the deductibles, what are the limits. Are there regulatory changes that say from this year to the next, this is also covered? And then the mixture of all of that is part of explaining the picture before. Changing vulnerabilities is another group of factors, and you'll hear more from Catherine. Some of these are actually reducing the risk and the loss is happening because we talk about prevention, mitigation measures. Some, like the sealing of surfaces, when you have the rainfall and the flood, acts in the other direction. So it's an easy question, how much of those losses is to climate change, but the answer, not that straightforward. The next slide gives a bit of stats of the urban population and how it moves. Just as an example, these are charts from the UN. Most of you would be familiar with them. To quantify and just to display that urbanization, we've had in the 50s only 30% of the global population being in urban areas. Today, that ratio is about 50, and the population itself has grown, and is projected by the 2050, the ratio of urban population to be about 70. And all of that matters today. And where exactly these macro trends and that warming climate, which amplifies, well, they play a role today the most, are in what we call secondary perils. It's a terminology we use in the insurance industry, modeling industry as well. Maybe by now, that would be the next slide. It's more or less subsided with you. The primary perils are these big earthquakes, hurricanes, the winter storms. They're the ones that have for years and for a long time attracted attention, exactly because they have that big loss potential. For a corporate, however, the secondary perils would be at least equally as important, if not more. And when by secondary perils, one has to often differentiate between two forms. One is what we call secondary effects of a primary peril. So think of a tsunami after an earthquake, not linked to climate here, but just for sake of definition. Or think about the rainfall induced by a hurricane, Hurricane Harvey, or a typhoon Hagibis. Those are the secondary effects which we put into that category. The independent high-frequency secondary perils, where the severe convective storms, the wildfires, the floodings belong. These are the ones that are rather small or medium size. They would happen more often. And for a corporate and a risk manager, they're most likely even more important, because they would be the ones that would hit the retention of the insurance program. And then something happens in UK, you're covered globally, maybe then something happens in Australia and your retention gets hit a few times and it becomes a liquidity issue. So that's why these secondary perils, I want to show you some high-level statistics about them. And if not today, in the coming days and next year, Sigma, you would see really Swiss Re talking a lot more about these secondary perils. So where they belong, that would be the last slide. Of these 50 years of losses, where Sigma and Swiss Re Institute tracks, the secondary perils represent about 60% of those insured losses, and that's a big number. And among that family of secondary perils, the severe convective storms, they don't get that much attention in the media because they happen locally, rather here and there. That's not the big event that you would see as an earthquake or a big hurricane. But those are, for these 50 years, approximately 40% within the secondary perils family, and the last 5 to 10 years, that ratio goes a bit higher. One cannot but mention also the wildfires, because that's where that's a lot in the media, and those are that's where insured losses from secondary perils are rising the fastest in the last 5 to 10 years. And with this, maybe to summarize very quickly, the takeaways from what I wanted to convey is that insured losses and economic losses from natural catastrophes are on the rise. Climate change is an amplifier, but it's a lot more and more complex macro trends like urbanization, economic development, insurance coverage, etc., that influence those trends. And what we have to watch out more in the future are really the secondary perils, because that's where climate change and macro trends matter the most. And with this, over to you, Beth.
Brilliant, Jordanka. Thank you so much. That is such a good basis for us to have the rest of this discussion on, that idea of the primary and then the secondary effects. And it's a really good segue for us to hand over to Peter to begin understanding how we're modelling those. Because ultimately, if I was in the shoes of a risk manager, I would be wondering, what does this risk mean for my business? And I'd be thinking, how would it affect my assets? I might be thinking, how does it affect the way my business operates, whether that's supply chain, whether that's even the attractiveness of my products. And so I love that you've laid a very strong groundwork there for the rest of the discussion. Thank you very much. What I'd say to everyone who's in the audience is we have planned to have some time for questions. And so could you write them into the window, please? And then we can either answer them if we have time at the end, or we'll save them up. And then if you say who the question's to, we can reply to them individually. But we do want to make sure that we're fielding all of the questions I guess you have about this important subject. Okay, cool. Thanks, Jordanka. I'm going to hand over to Peter now. Peter, as I mentioned at the start, works for AIR and is a long-standing expert in the field of modelling. And so, Peter, you're going to be discussing with us the ways in which we can begin to quantify and account for climate change in catastrophe models, and the other tools that are becoming available to help each and every one of us get our arms around this. I know you're going to be speaking from the experience that you have at AIR and potentially drawing in some of the other modelling approaches. Really looking forward to your presentation today. So over to you.
Well, thanks, Bev. And actually, I'd like to echo Jordanka's gratitude for having me on this panel. I'm delighted to be a part and present and hear some of the questions. So I will talk about some of the methods, I guess, from my perspective and experience, but also to the extent that I have knowledge about what other research entities are doing. I'll make a few comments about that at the end. But I want to start, and I'll just answer the question very briefly by saying, can we quantify the risk from climate change? And the short answer is yes, but like with any short answer, there's a story behind it. So I'll tell you a little bit about that story. A couple of years ago, we conducted a poll across the insurance industry to see what time horizons were of interest to the insurance industry. I mean, typically one would think that a very short time horizon would be of greatest interest, and that is true. You see that reflected in the spectrum of responses. But interestingly enough, and remember this poll was conducted a couple of years ago, interestingly enough, there is some interest, and it's a growing interest, in the longer time horizon. So being able to quantify the risk from climate change, not just on very short timescales of 1 to 5 years or 5 to 10 years or even 10 to 15 years, but on longer time horizons, say of 20 to 30 years and even beyond towards the end of the century, we're finding that clients are having a growing interest in that. So I'm going to talk about a few ways to address or quantify the impacts from climate change across the spectrum in about 5 minutes. Here goes. One way, especially on very short time horizons, is it all comes down to being able to understand the recent historical record. Jordanka mentioned, and rightfully so, that the objective of a catastrophe model is to really represent the current risk, almost regardless of whether that risk is being influenced by climate change or climate variability. This is what the client, the insurance industry, really needs in order to do their job. But that said, it's important, especially when we're building a catastrophe model, to reflect the risk out to, say, even 10 years. We do have to understand the trend, and we look for those trends in the recent historical record. That's the first thing to look at. Is there a trend? If there's a trend, is it the result of climate, not just climate change, but climate variability? In other words, is there a physical basis for it? Or is it the result of changes in technology, measurement technology, or population biases, etc.? And if it is climate related, is it significant? That's important as well. We don't necessarily want to react to every little nuance, even if it's a long-term slight increase or decrease, etc. And another question to answer or to consider is, what is the variability like? There's lots of variability. You see that reflected in 3 examples I'm showing here for U.S. tornadoes, U.S. wildfire in the upper right, and annual precipitation. Some of these graphs are showing some trends, some are showing variability that's spurious. For example, if you look at the number of wildfires, there was obviously a change in measurement practice that influenced that. We wouldn't necessarily incorporate that, or we'd have to do something special in terms of building that into the model. And then even if there isn't a trend, like what you see in the lower left with U.S. tornadoes, on a national scale, there may be trends in other aspects. For example, changes in regional activity, shifts in geographical distribution, where activity is becoming more frequent, for example, or changes in seasonality. The example on the lower right is probably the cleanest example for annual precipitation over a large region. There we do see the variability. We see a slight and gradual increase that is very likely the result of climate change. So that is something we would act on. We have confidence that it's the result of climate change because we see it in the historical record. Computer models are able to replicate this result, and we understand it physically. A warming atmosphere will hold more water vapor, and the whole hydrological cycle is accelerated. So building these trends into the catastrophe model will help the model to better reflect, to the extent that the trends are the result of some physically plausible mechanism, help make the model represent the current risk. So let's look at a couple of solutions for longer term horizons. Clients are definitely interested in the 2050 time horizon as well as the 2090 time horizon, for example. So even there, by using a catalog that is built to represent the current risk, if the catalog is large enough, in other words, it contains 100,000 years or realizations of the current climate, we can resort or subsample that catalog appropriately so that it will reflect a different climate in the future. By defining a climate change target, and that target is not necessarily easy to identify. I'm showing an example here of change in hurricane activity between late last century and late this century, an increase in category 4 and 5 hurricanes. We can use that to define the climate change target and then appropriately subsample. And you can see the distribution of the different frequencies in the upper right-hand graph. And that yields a difference in loss, which is represented in the lower graph. So in this particular example, this particular change in categories 3, 4, and 5 hurricane activity, which is informed by the scientific literature, leads to a change in loss of AAL on the order of about 20%. So this is a helpful tool that can help insurers quantify their risk for the future. If we look at the next slide, here's another example of a tool that can be used to help insurers evaluate the sensitivity of their portfolio to particular aspects of climate change. By considering how a particular hurricane event in this example may manifest itself in a future climate, changes in forward speed, a change in storm size. As sea levels rise, that will affect the storm surge intensity, the very storm intensity itself in terms of changes in central pressure, and the precipitation rate. So as storms slow down, that can influence the precipitation rate. As storms get stronger, that can influence the precipitation rate. And by mixing and matching these different perturbations, say 2 or 3 perturbations for each of these aspects of the event, we can create an entire suite or a collection of events which clients can then use to evaluate the sensitivity, like I said, of a particular aspect of climate change on their portfolio. So the last slide, I'll just wrap up by saying I talked a little bit about the first 2 aspects, the climate change scenario as a tool that can be used to help understand or quantify the risk of climate change in the future from one particular perspective. A broader perspective is, like I said, to create climate change condition catalogs from subsampling or another technique to help quantify the risk from climate change in the future. But more generally speaking, if we could create a model where we swap out the data that we use to build the model currently, say from a reanalysis data set, with data from a general circulation model that's reflecting a future climate, then effectively we can build a model from scratch that will reflect a future climate. And then by comparing that model or the output from that model with output from our current climate model, that will also be a way in which we could quantify the risk from climate change. So that's kind of it in a nutshell. I know I was brief. I tried to be comprehensive. I'll look forward to the questions. Back to you, Bev.
Marvellous. Thanks, Peter. It's, I know, a whirlwind tour for everybody and a bit of a 101 on climate modelling, but your Dank has done a great job of showing us the global picture. So, Peter, thank you for then deep diving on hurricane. What I would say, in addition to your comments there, are that there are many models out there in the market, and you're explaining one approach of doing it, which is aligned with catastrophe modelling. Interestingly, in the last 6 months, I've been part of the Marsh review panel, and we've reviewed 15 different climate models because we've been trying to decide what's fit for purpose and best for our clients and the people we work with. And it's a minefield. There are so many different factors. And yes, the type of events that are driving it is one, the resolution or the detail and granularity, the perils that are covered, the way in which scoring is reported. I mean, there's just so many different factors in there. And I feel like, Julia, we should have an entire separate session on the nuances and pros and cons of different modelling approaches, because I'm sure as people move into a world like the Bank of England stress tests have forced the banks to do, of deciding which models to use and justifying it, you're going to want to understand the pros and the cons. So you focused very helpfully there on hurricane. What I'm going to do now is pull us back into a world of flood, and want to welcome Catherine, who's going to be briefing us on this. Catherine works for FM Global and is an engineer and a property insurer who brings together that world of knowledge around the practicality of what you need to do at a building level to help cope with the kinds of climate increase that we've been hearing about. We've already had one question in about resilience and how we are going to be dealing with it at a property level, Catherine, and I'll come to that at the end. But what I'm looking forward to from your session is us getting very grounded in, if I have an asset and it has risk, what do I do about it? How do I assess it? And then what practical measures are involved in doing that? So you lead a team of engineers. You are hands-on on the ground doing this. Let me hand it over to you to walk us through some real life examples. Thank you.
Thank you very much, Bev. And it's great to be here. And it's great to be able to share on this important topic. So climate risk means a lot of different things to different people. For the cranberry farmers in the northeast of the US, they're concerned about the fact that they need to have cold winters and mild summers, and the climate is changing, so the farms are migrating further north. For a dermatologist, they're concerned about people wearing sunscreen. For someone who's a bird watcher, they're seeing species migration patterns change as the climate is changing. But for myself, being someone who works in the property insurance industry, I equate climate change to natural hazard events. And we are seeing an increase in extreme precipitation events that lead to flooding. On the far side of that precipitation scale, we're seeing a decrease in precipitation in some areas, and that's leading to wildfires. And then, of course, with the warming oceans, we see an increase in the hurricane and tropical cyclone activity. And in fact, 2020 has been a year for the record books. There were 29 named storms in the Atlantic Basin this year, and over 4 million acres of land burned in California alone. Tropical cyclone activity in the Asia area was very high as well, and we've seen floods from China to Chicago this year. So some people ask the question, well, is there a way that we can measure the financial impact on the business market? And last year, FM Global commissioned a study to ask this question to Pentland Analytics. And they investigated floods from 2015 to the current, looking at where major floods had occurred, and these floods were around the world. So for example, in 2015, storms Desmond, Eva, and Frank hit the UK and Ireland. In 2016, storms Elvira, Frederic, and David hit Germany, France, and Belgium. In 2017, Cyclone Debbie hit Australia. All those storms brought with them some pretty major flooding. And then, of course, there were storms that were analyzed that hit the US and Asia as well. What Pentland Analytics did was look at those publicly traded organizations that had reported a financial loss due to flooding, and then tracked their stock for a year to see, does it go up, does it go down? And what they found was that there was a 5% hit on average to the market value of those organizations who had reported a financial loss due to the floods. And this is taking out all other market impacts. Pentland had done a study after the 2017 hurricanes and found something very similar for those companies who had recorded financial losses from the hurricane. So yes, we can quantify the financial loss. After those 2017 hurricanes, Hurricane Harvey, Irma, and Maria, FM Global took a look at the damages that the models had predicted, and some of these are the models that Peter had talked about earlier, and compared that to the actual losses that FM Global clients had seen from these hurricane and flood events. And we found that there was a marked difference. Now, this isn't a problem with the models. Rather, it points to the engineering difference of engineered solutions. So those clients who had put in place engineered solutions against flood, such as using floodgates, saw that their damage was 20% of that for the clients who hadn't used any kind of flood protection. And on the hurricane side, on the wind side, those clients who had secured their roofs against hurricanes or being blown off and anchored their rooftop equipment saw that their damages were just 25% compared to those clients who hadn't made any kind of improvements. So we see that this engineering works. It can make a real big difference in terms of the amount of damage that we're seeing from these different events. And putting in place some of these mitigative solutions can help a business or an organization maintain their competitive advantage. And I've got an example of that. FM Global works with one client who has a portfolio of retail stores, and their risk management philosophy is that they want to be the last to close and the first to reopen anytime there's a hurricane. So in order to do that, they've had to harden their facilities to make sure that the hurricane can come and the hurricane can go, and they're going to have minor damage to be able to open right away. And with that, Bev, I'll turn it back to you for questions.
Thanks, Catherine. I think that's a wonderful philosophy, last to close, first to open. We've tended to say if you flood on a Friday, be back up and running on a Monday, but I actually like your one a little better than this one. I think one question I'm just going to kick off with you is that, do you feel, some people might feel that it's actually a bit expensive trying to do resilience or to mitigate against something like a flood? I mean, what's your experience with that?
Yeah, the experience that we have working with our clients is that it can be very, very cost effective. And I've got some examples to share with you. So this is an example of a client who has flooded. It's a manufacturing location. They're printing packaging that's used in the food product industry. And they've put in place some very simple and low cost solutions that have significantly lowered their flood exposure. So one of the ways to protect against flood damage is to elevate. So what they've done is taken the storage out of the lower level of their warehouse. They put it into storage containers. They park those storage containers out in the parking lot in an area that's high. And you can actually see them in that overhead photo. All that brown stuff that you see in that photo is the flood water that's surrounding the facility. And then you've got the storage containers off into the dry area. Some of the other measures that they've put in place, and again, very, very low cost measures, is that they've elevated the control stations to be above flood level. Now, this particular location has flooded in the past. FM Global has worked very closely with them, and they know how high that flood water is going to be. It's predicted to be about 28 inches, about 50 centimeters, or knee high. Throughout their facilities. So by elevating their control stations, they're able to keep those out of the water. Now, another really clever thing that this client has done is to remove some of the drawers from their parts cabinets, and they simply put those on top of the cabinet itself. Again, elevating it enough to be out of the flood waters. And this was done very strategically because in one of their earlier floods, they lost a lot of equipment. They needed to do a lot of repairs on site, and they needed the parts to be able to do that. Well, without the parts in the parts cabinet, they couldn't get back in business right away. So the different solutions that this particular client has put in place has really helped them drive down that exposure from the flood. They were able to keep some water out of the facility through some of the measures that they had. So they did have water in the plant, but it was only 17 inches compared to 28 inches that they had in a flood 2 years earlier. They were able to keep 280 of their motors dry, which allowed them to do just a cursory cleaning of their presses instead of needing to do a major overhaul as they had the previous flood. That allowed them to minimize their downtime to 2 weeks. And cut their loss value in half from about 10 million down to 5 million. Another quick example I'll walk through are some engineered solutions. Again, very cost effective. And there are two buildings in downtown Houston that were hit by flooding from Hurricane Harvey. They both had emergency response teams. One of them had an engineered solution and the other one decided to use sandbags. Now, also pay attention to some of the things going on in these photos. On the right-hand side, their emergency response team was a bit more robust. They knew that they had to put the floodgates in. They knew the hurricane was coming. It was a very well predicted event. And they're out there in the daylight putting their protection in place prior to the rain starting. And compare that to the left-hand side, where it's now nighttime. The rain has already started. They're in their rain slickers and they've got their umbrella there. And let's see how this played out in real time. One of those buildings ended up flooding. They got water into their basement parking garage. The other one, the floodgates that they had put in place, the engineered solution held back the water. Now you see that pickup truck in the background, and these were parking garages, but it wasn't that truck that they were trying to protect. In most high-rise buildings, as in these high-rise buildings, a lot of the infrastructure is in the basement, whether that be the telecommunications equipment, the electrical switchgear, the fire pumps. And if that stuff gets wet, you can't occupy the building. So again, these measures really make a difference towards the resilience of an organization. Beth, back to you.
Thanks so much, Catherine. And while you've shown an example there, which is focused on the US, would you comment that the same principles of resilience could be applicable in the UK?
Oh, they're definitely applicable, yeah, around the world. And in fact, we do have clients in the UK and in Asia who have put in place similar measures. And in fact, a lot of the FM approved product that's been proven to be reliable in a flood is now being manufactured in parts of Europe and in parts of Asia, making it much easier for those locations to find something they know is proven to work.
And given that we're here today talking about climate change, climate quantification, a couple of the takeaways I've had is that know what your flood depths are potentially and know what they are today, but know what they are also under the climate change scenarios, as Peter's discussed. And then the other thing I'm heartened by is that certainly here in the UK, we have the government, which has just launched a new flood emergency flood code of practice called the Property Flood Resilience Code. And so we now have some very good guidelines as businesses, as homeowners, to actually assess and begin thinking about the kinds of mitigation strategies, resilience measures, risk, resilience, recoverability, all of those things, what works for you and what should work for your business. Before I go into wider comments, one last thing that I know is important for sort of you, Catherine, Jordanka, Peter, you all recognise that how we deal with climate change is partly about how we deal with the physical risk by making adaptations to a property, but it's also about the people, because you can't actually know that you're going to have a good response unless all of your team members understand what their role is and what they should be doing to help deal with climate. You can't put a barrier in place if nobody's assigned to do the job. And we call that a flood emergency response plan. And so just knowing how other insurers I work with view it, they view the two things hand in hand. Number one, have good physical measures, but also have a good team who know what they're doing, have trained, have exercised. I mean, it's part of sort of classic crisis response, isn't it? But those things have to go hand in hand to take the data and then do the right thing about it.
Exactly. Yeah. And in fact, I recall one particular client who saw floodwater coming in and they immediately moved the toilet paper out of the way. And this was before the pandemic when there was a toilet paper scarcity. But they were so concerned about the toilet paper getting wet that some key records and papers that were one of a kind ended up being destroyed in that particular flood. So you really have to know what's going to happen and be able to have a strategy in place to address the biggest vulnerabilities for your facility.
Absolutely. So thank you, Catherine, Peter, Jordanka, for the wonderful presentations. I've got a few questions that have come in, so I'm just going to bash them out. And I think the first one's probably to you, Jordanka, which is, what do you think about uninsurability? Is this a topic that's going to become more important as we see climate change hitting?
Thanks, Bev. Successfully unmuted myself while muted. Insurability and uninsurability, that is a topic actually, and that's why most regulators are looking to any companies, but also to the insurance companies, because insurance companies are there to help with the protection of the individuals and societies. When we talk about insurability, we have to differentiate between these different climate change paths. In which of these scenarios we are in? Are we talking the 2 degrees increase? Is it the 3 or the 5, or which one of these it is? And I think Martin Bertok alluded earlier this morning that when something is certain, when you know the flood is coming every year, that is not something that becomes insurable. If you cannot on one hand side put a protection and then still put the properties behind that protection when you know it is maybe not really adjusted to what's going to happen. So it's not a very easy and straightforward answer, but it's absolutely a topic, the insurability. It goes along hand side. Will it be affordable? What could be covered and not? Just an example, and a bit linking to Catherine and the example of flood. After 2002 in Germany, what happened after these the floods was that premiums increased after that event, because then all of a sudden people are aware that the risk has changed. Actually, a different price is being demanded. But not only that, there was little bit of less coverage available as well. So the topic is valid, and it all depends under what temperature increases we're working, which peril, where in the world. So absolutely a topic.
Thank you. Again, I think that warrants a whole separate, longer conversation. So I've got one I think I'm going to put to you, Peter, and thanks, Anthony Connolly, for the question. So the search for a COVID vaccine demonstrated unparalleled global scale cooperation to achieve an end result. How is it that insurers as consultancies, why don't they combine modelling efforts to, in a way, produce the best climate model in terms of both accuracy and transparency? Controversially, Anthony says, there seems to be a lot of IP protection going on. Discuss.
Yeah, I was definitely going to point that out. So thank you for doing that ahead of the game. But I mean, besides that, I think we are actually working in or towards that perhaps general solution. There are organizations, I know, for example, one in the past, it was an attempt to bring together the academic community as well as insurers to discuss some topics that were of importance. This was some years ago, and the focus was more on, say, weather and climate as opposed to climate change, but that is changing now. And so I think there is more cooperation across the industry and across the community to work towards more general solutions. I mean, maybe having an open model framework will help. There are different strategies that can be implemented to work towards that. But it's absolutely true, Bev. I mean, I definitely believe that this isn't a problem that's going to be solved by any one individual community or any one academic institution. It is, like we saw with COVID, it's going to take a global effort.
1,000,000% agree. And one thing it strikes me is that global climate modelling is category of hard. And at the moment, I think we're still trying to figure out what is the best in class modelling methodology. It varies by peril, and it is something that I think there'll be convergence towards as we do more of it. I've spent the last year doing a 101 on the different climate models, and even that part of it, if you imagine the climate then drives what happens at the ground surface, there's so much variation by geography, by the different driving factors, by the science improving. And I think that's generally where I'm seeing that we are, is on a journey of learning and generally trying to improve and improve accuracy. So I think sort of Anthony, thank you very much for the question. And I believe that as we see more initiatives like TCFD and stress testing coming forward, we're going to see improvements. There's more people who are going to get in the game. We're going to see more knowledge about it and sharing. Inevitably, the whole of that modelling piece will continue on an upward trajectory. So really good question. And I think that we should kind of come back and revisit this topic in a year and say, how different are we in a year's time from where we are today with the modelling?
Great idea.
So thank you. I've got another question here, which is perhaps a little bit more for you, Catherine.
And I think, Bev, just to interrupt, sorry, this must be the last question.
It is, yes. Don't worry, I've got it in mind. So, Catherine, this is one from, I can't see who sent it, but engineered solutions have their place. But it would be good to find out what you particularly think of nature-based solutions, particularly for flood management.
Yeah, I love this question. It is a fabulous one. And my mind always goes to the nature-based solutions are the best. And the reason that we have to look towards flood protection for facilities is because facilities are building in locations where nature says, no, I want to use that for my floodplain. So, I lived in Belgium in the middle 2000s, and at the time there was a huge initiative going on in the Netherlands called Room for the River. So the Netherlands has recognized, and this is a nation that is 2/3 below sea level, they've recognized that they can't keep building their levees higher and higher to be able to contain the floodwater, that they needed to make more room for the river. And that led to some very hard decisions and, the movement of people and communities out of those floodplains. But that should always be where our minds are going first. It's hard to relocate things that are already existing, but it's much easier to have codes that say, do not build in a floodplain. And that should always be the first place that we go.
1,000,000% agree. So listen, we're just about out of time, and I want to say a massive thank you, our wonderful international cast, Jordanka, Peter, Catherine, for just sharing your wisdom and your insights. I hope that everybody in the audience has found this to be a useful session, and I'm sure that if you reach out to Julia, you can get contact details for us, a copy of the slides, but any other questions, feel free to shoot those over, because we always run short of time on these. I'm going to hand it back to you now, Julia. Thanks very much.